There is one feeling in Britain we are taught to chase from the moment we start working. It is the weight of a set of keys landing in your palm. The estate agent shakes your hand. Somebody takes a photograph of you, standing in an empty living room, with a bottle of something you cannot really afford. In 2026, getting the keys to a 3-bedroom semi-detached feels like winning a war that most of your friends are still losing. And then the first full month happens. You open your banking app on any quiet morning, and the number at the bottom of the screen does not look like victory. It looks like survival. The mortgage has gone out. The council tax has gone out. The insurance has gone out. And you are sitting in a house you supposedly own, doing the arithmetic of whether you can afford to have anybody over at the weekend. This is the trap nobody warns you about, because the moment many British buyers step over that threshold, they quietly stop being owners at all. They become unpaid caretakers for somebody else's asset, the bank's asset. Here is the part your solicitor will never sit you down and explain. At a 5% 5-year fixed rate, in the first 5 years of a standard mortgage, roughly 70% of every single pound you hand over is not buying you anything. It is rent. It is interest. It is the fee you pay the lender for permission to stand inside the building. Take a realistic first-time buyer position, a mortgage of £240,000 at 5%, stretched across 35 years to pass the affordability check. That is a monthly payment of about £1,211. Now run it forward 5 years. You will have paid in roughly £72,600. Your actual equity gain, the part of the house that becomes genuinely yours, is somewhere near £14,400. £72,000 out, £14,000 of ownership in. On a longer term, that ratio gets uglier still. You are not building a mountain of wealth in that first decade. You are paying a premium for the right to paint the walls whatever colour you like. You are a tenant of the bank, with a far higher maintenance bill and no landlord to ring when something fails. Think of it like this. Imagine you have been handed the keys to a beautiful private gallery, marble floors, high ceilings. Your name is on the visitor's book. You are responsible for keeping it spotless, for fixing the windows when they crack, for keeping the lights on and the bills paid every single month without fail. But you do not own the gallery. You own the smallest corner of the smallest room at the back. The bank owns the paintings. The bank owns the walls. The bank owns the roof over all of it. And you are the unpaid guard, working a full week to keep a collection secure that belongs almost entirely to somebody else. The moment you stop paying, the moment you fall behind, the guard's uniform comes off, and you are escorted out of a building you spent a decade cleaning. That is what a low equity share with a high loan to value really means. On a 95% LTV deal, you own about £5 of every £100 of that house on the day you move in. The rest is a promise. And this is where 2026 has quietly changed the rules. Over 30% of first-time buyers are now taking mortgage terms of 35 or 40 years, not because they want to, because it is the only way the affordability calculation returns a yes instead of a no. Stretching the term drops the monthly payment, the lender's stress test passes, and everybody smiles. But understand what you have actually signed. If you take a 40-year mortgage at age 30, you have not bought a home. You have leased your entire working life. You will still be making payments on that first flat long after your own children have finished university. You will carry that debt past the age most people expect to stop working entirely. And every additional year on that term is another year of interest flowing out, tens of thousands of pounds, quietly, in the background, for the privilege of a slightly smaller number this month. The term stretch does not make a house more affordable. It makes an unaffordable house survivable and charges you your 60s for the favour. Now add the siphons. The average Band D council tax bill in England for 2026 is £2,392. That is up almost 5% in a single year, and it is the 4th year running that the increase has landed near 5%. It is not a bill you can negotiate, shop around for, or opt out of. Buildings insurance adds around £306 a year on average, and if you want your possessions covered too, the combined figure is closer to £375. And if you have bought a leasehold flat, brace yourself. The average service charge in England and Wales is now £2,405 a year. That is over £200 every month, before you have touched the mortgage, the council tax, or the ground rent. Charges you do not control, for work you did not commission, decided by a managing agent you have never met. Here is the cruel mechanic. When you step up, when you finally move to that larger house in the home counties, the reward for years of hard work, you do not just take on a bigger mortgage. You trigger a jump in your council tax band. Your insurance premium climbs with the rebuild value. Your fixed monthly floor rises permanently, and it never comes back down when your income has a bad year. That is a tax on success. And unlike anything HMRC sends you, this one has no allowance, no relief, and no appeal. Building equity in a 5% environment feels like a specific kind of exhaustion, and there is a reason for that. Picture yourself trying to run up a steep sand dune. You take 2 hard steps up, that is your monthly payment, the money you fought for all month, and the shifting sand of interest carries you 1.5 steps back down. You are still moving. Technically, you are ahead. But your legs are burning, you are drenched, the effort is enormous, and when you look up, the view has barely changed. That is what the first decade of a stretched British mortgage feels like from the inside. Enormous input, almost invisible progress. And the temptation is always to blame yourself for not trying hard enough, when the truth is that the ground itself is moving. Then there is the housing stock itself. Britain owns some of the oldest housing in the developed world. Beautiful, characterful, and expensive to keep standing. A garden wall that starts to lean, damp creeping up a rear extension. A structural crack that a surveyor uses the word movement about. Any one of those is a £3,000 conversation, and it arrives with no notice and no payment plan. For a homeowner with a healthy margin, that is an inconvenience. For a high-leverage buyer, on a 40-year term with a 90% LTV, it is a financial heart attack. It goes straight onto a credit card at a rate that makes the mortgage look generous. And if your fixed deal ends in that same window and you roll onto the lender's SVR, you are absorbing 2 shocks at once. So where does real ownership actually live? It lives in the margin. If your total housing costs, mortgage, council tax, insurance, service charge, ground rent, all of it, exceed 30% of your take-home pay, you do not own a home, you are a prisoner of your own postcode. Every pay rise gets absorbed, every emergency becomes debt. Every opportunity that requires a little cash or a little risk gets declined, politely, because the front door has already claimed the money. Under 30%, something different happens. There is room to overpay the capital and cut years off the term, room to keep a proper emergency fund, room to feed an ISA and build something that grows while you sleep, instead of something that only stops costing you when it is finally paid off. Nobody talks about this on completion day, but the feeling of working from Monday to Thursday just to pay for a front door you are rarely home to enjoy, that is not a personal failure. That is the structure, working exactly as designed. Home ownership in Britain should be a foundation for wealth, not a cage for your income. So before you stretch the term, before you take the maximum the calculator offers, ask the only question that actually matters. Does this house allow me to build a life? Or does my life now exist purely to serve this house? Because the keys are the easy part. The freedom is what comes after. If this video helped, make sure to like and subscribe. I'll see you in the next one.